Alok Agarwal, Alchemy Capital Management, joining us this afternoon to give us a sense as to how he's looking at markets. Alok, hi. Firstly, very good afternoon. Elevated oil prices, keeping a lid with regard to how markets have rallied at least over the last month or so. How are you playing this?
Yeah, hi, good afternoon, Harsh. It's quite an interesting time in the market with Brent crude hitting $125 and a kind of a record month that we have had this year. But we also need to understand the fact that India's growth story has been quite resilient. Even the recent projections on the growth numbers for this year stand at around 6.5%, which is quite a good positive. And we must also note the fact that a lot of these negatives seem to be in price as well. Over the last 1 year, the Indian markets, if you look at MSCI India, that has underperformed the emerging market index by over 50 percentage points. So a lot of those are also there in the price. Nevertheless, as long as the Brent crude prices remain elevated the way they are, that will obviously have an overhang on all the macro indicators, be it the deficits, be it inflation, as well as have a negative impact on the earnings as well. So it's an interesting time to look at those sectors and areas where the growth is quite structural and kind of avoids and stays away from the volatility caused by the crude oil prices.
What's the risk to earnings, Alok? Are you being cautious? Are you looking at this as an opportunity every dip?
No, the risk to earnings is quite understated as of now. The way we are seeing the Q4 earnings, they are quite decent so far. And but till March end, as it is in India, the retail fuel prices have not yet been increased. Before the war, the Brent crude prices were slightly under $70, and now we stand at $125 on the financial markets that we see, and the physical prices could be slightly higher. So there would be a pass-through of some kind of this increase in the Brent crude prices, which then will have an impact on the margins of the companies. And we are already seeing, if you look at the FY27 EPS estimates, after a gap of nearly a year, in the last 1 month, we had a downgrade of close to 1%. So that's a consensus number. So as the retail prices of fuel go up, there will be an upward impact on the inflation as well as some downward impact on the earnings. But that downward impact cannot be overstated. There will be certain sectors which will have a slightly higher impact because crude and related derivatives, they form a significant part of their costs. But then there could be sectors and segments which could actually stay away from this kind of cost pressures and actually deliver good growth. So that's why it's an interesting time. But nevertheless, rising crude definitely means some kind of downward pressure on the earnings growth.
Yeah, I mean, Alok, a lot of the Q4 earnings have been really good, right? But the commentary hasn't signaled anything materially negative. Do you believe that these uncertainties haven't been fully yet spoken about, or you believe that broadly this has been baked in or built into?
It's difficult to say it's fully built in. As we mentioned, given the fact that we have significantly underperformed the emerging market index in the last 1 year, to a large extent, it seems to be built in. This year, so far, FIs have sold more than $20 billion already. So large part of selling is already also seen. India happens to be the biggest underweight for FIs in the emerging market funds. So, they're already positioned for a rising crude as well as a falling rupee. The moment we start seeing some de-escalation in the war, the moment we start seeing some kind of peace treaty being reached and the Strait of Hormuz being reopened, and thereby a big downfall in the crude as well, India suddenly will start appearing quite attractive. So the risk reward currently is in favor of India, but nevertheless, in case this kind of stalemate situation persists for longer, and in case that leads to crude oil prices being higher, that could pose some near-term risks. But these are all, any kind of fall that can happen because of that would actually present themselves as an opportunity, primarily because most of these factors are largely priced in.
And Alok, so are you buying selectively? Is this something you're doing at the 24K levels? Did you do it at 22,300 odd levels at the lows? Have you been stagger buying all throughout? Give us a sense of what strategy you're following at this point, what sectors you're looking at.
So our strategy is more to follow the path of least resistance. So the segments that have the maximum tailwinds and the minimum headwinds in terms of earnings growth are the areas that we really like. We find structural growth stories coming from metals and mining, capital market segments, and we also see power and allied the power infra kind of areas to be very, very positive. Defense is the fourth one that's very positive. So some of these segments offer great opportunities in terms of longer runway of growth. Some of them are attractively priced as well, and a lot of them are not really impacted by this crude uncertainties too. So these areas are dominating our portfolios currently, but some of the index heavy weights are the ones that are actually suffering from lower growth rates already, and their earnings estimates are not seeing a material uptick too. So that's the kind of difference that we are having in terms of sectoral allocation.
So let me talk about power a bit, Alok. Power has seen a bit of a re-rating already. How are you playing the power theme? Just so many ways to play it.
Yeah, absolutely. See, Harsh, in India, last year we had surplus power. So this year, there are multiple things that are at play. Firstly, there's a heat wave due to which the power demand has gone up significantly. India is a very well balanced kind of a market where the demand and supply almost balances out while there are peak deficits twice a day. But at the same time, there's a structural change that's happening. India's participation in this overall AI boom is happening primarily through the data centers. So these hyperscalers are committing money for making and building data centers in India, and the government is also showing its commitment with a 10-year tax holiday. And all these data centers do require a lot of power. So when you play this power segment, there are segments to play on the generation side as well as on the transmission side. And those areas which are slightly shorter supply with better pricing power, that part of value chain we like a little more, be it the transformers, be it some things on the HVDC lines, and some of the equipment suppliers as well.
Okay. What about the power financiers, Alok? Would that at all attract our attention?
Actually, we prefer the manufacturers over the financiers. And in terms of financiers, because they could go into areas not related to really core power area, and thereby the credit cost, etc., is far more difficult for us to really go through. So the key winners for us lie more on those manufacturers and equipment makers than on the financial side. So we are not really there on the power financial side.
Alok, what about some of the lenders? Would that interest you? Would IT interest you? Those have been two sectors which have underperformed, especially the private lenders and IT.
Space is pretty interesting now. So, the Goldilocks situation happens when your credit growth is above 12%, deposit growth is above 12%, and credit costs are low. In India, currently, it could be inflation driven as well, but the credit growth is standing above 15%. That is highest we have seen in over a year or two. The credit growth, the deposit growth has also come back to 13-14% mark, which is also a big positive. While the credit costs are low currently, the ECL norms the revised norms that have come out may show some kind of more provisioning required, but these are positive data points. And the lending is, as you mentioned, because they are also facing higher selling pressure from the FI side, have underperformed. They do present a better risk-reward opportunity going forward. Our preference is more for PSU banks and smaller private banks than the large private lenders. But this segment is slowly improving its own risk reward.
Okay. Thank you so much for that, Alok. We'll leave it at that. Unfortunately, out of time. Would have loved to continue this conversation. Thank you so much for joining.
Thank you.